show. Joining us now are Tony Zabigala, the Strategic Wealth Partners COO and Senior Wealth Advisor, and Great Hill Capital Chairman Thomas Hayes. Gentlemen, thank you both for being here on this holiday week. Tom, I want to start with you because the majority of the S&P 500 gains, if we get our record here today, which we will keep an eye on, they're coming from the Magnificent Seven. But, you know, there's concern that they could be overvalued, even if we are still expecting to see significant profit increase come earnings season. So I want to get your take. I mean, will we see some profit taking in the market as we head into the new year?
Well, Kelly, thanks for having me. You know, the market's come a long way in a very short period of time. And based on recency bias, people are saying, well, then we must correct 5 or 10% in the first quarter. And it would be natural to get some consolidation or a little bit of volatility. But I wouldn't get too cute with it because we've had 0% gains in the S&P for over 2 years now. We've been consolidating sideways. And it's very difficult to short new highs. I think the opportunity, Kelly, is going to be in the relative value. In a presidential year, the average return for the S&P 500 is about 11.28% since 1928. So that means the Magnificent Seven or the large caps are going to do less well next year than they did this year. And the opportunity is going to be in small and mid caps, which are trading at about 14 times next year's earnings, versus the large caps, which are trading over 20 times next year's earnings.
Yeah, Tom, you make a really good point about the election year as we move forward. All those eyes are going to be on 2024. I am curious to see if we're going to see some profit taking. We saw the European markets, the Nikkei, close down because of that. But Tony, I want to bring you in because I want to turn to some of these underperformers, right? Mag 7, 2023. Let's look at some of the stocks that could be winners here. You know, I was looking at research from Apollo, and they said 72% of the S&P 500 stocks underperformed this year. That is a record. And so you're advising folks to double down on stocks like Edward Life Sciences, Medtronic. Why?
Yep. So I look at 2024 as the year where 2023 laggards should outperform. And 2024, if we really look at it, could be a challenging year. They're expecting 12% earnings growth and a possibility of a recession. So given those headwinds, it makes a lot of sense to be overweight defensive growth names. Let's take a look at medical devices. Edward Life Science, Medtronic, like you mentioned, they've been dogs this year. And these two stocks right now have a very attractive valuation. So I'd expect them to rebound. And also dividend payers, you know, they've been lagging as well. If we take a look at the Dividend Aristocrat Index, it's only up 7.5% this year. So from a risk-adjusted standpoint, I believe dividend payers and, you know, medical device companies to be providing investors, you know, growth opportunities next year, and it's a way to also scale back some of the risk in their portfolio.
Okay, so medical device, that would be one space. You know, Tom, I want to bring you in because I know last time we talked, you were also bullish on essentially, okay, Mag 7, great, but there's a lot of opportunity in those small and mid-cap stocks. You know, I was looking at the Russell 2000. It's up over 14% in December. That's the highest growth that was seen in 3 years. So it does look like there's opportunity there. What are some particular stocks that you're looking at that could be good opportunities for 2024?
Yeah, well, small caps are still well off their highs. And Kelly, the last time you and I were on the Claman countdown together was exactly a year ago today. And we were talking about a small stock called Cooper Standard, which is an auto supplier. They do fluid transfer solutions and sealing systems for the original equipment manufacturers like GM, Ford, Stellantis. And we were kind of celebrating. It was up 25% since we originally talked about it to the Claman countdown audience in June of 2022. Well, now it's gone from $6.10 to $7.35 when we spoke. Now it's over $20 today. And despite the fact it's up 3x or over 200% now since we first discussed it on the show, we think it's just getting started. With the chip shortage now in the rearview mirror, they've refinanced the debt on their balance sheet, so solvency risk is off the table. And the UAW strike is in the rearview mirror. This company is now turning cash flow positive. You couple that with rates coming down and the average car on the road is 13.5 years, we're going to start to edge up industry-wide towards production levels that are near pre-pandemic levels when Cooper Standard was earning $7 a share in earnings. They've taken a lot of costs out of the business. So even if you apply a trough multiple to that earnings power in the next 12 to 24 months, we think it's got a lot of upside from here, and we're pretty excited about Cooper Standard.
It's an interesting point that you make about, 13 and a half years. I've been considering getting a new car. It is time to trade my red Toyota Donna, she is named, in, but certainly need to see prices move a little bit there. But Tony, Tom was mentioning rates coming down. Of course, this is something that we have all been laser focused on. The Fed is saying 3. The market is pricing in 6. It looks like those jobless claims that I mentioned at the beginning do show some good movement, some indication that, okay, maybe the Fed will cut rates at some point next year. But I'm also seeing some signs that the economy is still doing well. So my question to you is, should the Fed cut rates? Is it going to be too soon?
Well, the one thing I would say is, fear the cut, don't cheer the cut. Because the market has obviously melted up from when Powell came out and announced that he's expecting 3 cuts next year. And then the market took that information and is now pricing in 6 cuts. So 2 things can happen. They don't cut at all. That would cause what I would feel that treasuries would re-rate and they'd probably go higher. And stocks are not going to like that because they're going to have to finance debt at higher rates. Or they do come out and cut. And how do you cut when unemployment and inflation is relatively low? So at the end of the day, I got to say, just be careful what you ask for, because history shows that the market drawdown is around 20% after the first cut. And there's no reason to think that this time would be any different. Plus, if we start doing rate cuts, think of that as a form of stimulus. And do you think we really need more stimulus right now? So my thought is that the longer for higher is here to stay. And if they're going to be looking at cuts, it would have to be maybe in the second half of the year.
I really like that framing of it as a potential stimulus. I think that's a really interesting point. Tom, I'm going to bring you here on this. Fear the rate, cheer the rate. Last word to you. Got about 60 seconds.
Well, I think the market is ahead of itself with 6 cuts. I think the Fed is behind the ball with 3 cuts. I think we'll wind up somewhere in the middle, probably 4 cuts. And it doesn't necessarily have to be a bad thing for the market. If you look at a mid-cycle cutting like 1995, we had a great stock market and economy for the next 4 or 5 years. And also coming out of that steep hiking cycle of Volcker in the early 80s, when he cut, the market took off and it didn't look back for 18 years. So yes, recent times that they've cut, the market has gone down. But if you look back a little further in history, it could be a very bullish thing if they do it right.
Okay, well, we will see who is right. Tom, happy 1-year anniversary of our first time working together on air. Tony, let's do it again next year. Thank you, gentlemen.
Thanks, Kelly.
Okay, well, we are